There's been a lot of bullish activity in the options market, and this concerns us from an intermediate term standpoint. Hi, I'm Mark Arbiter, and this is S&P's Chart Room. Taking a look at a daily chart of the S&P 500 on the top here. The pink line is the 5-day simple moving average of the CBOE equity-only put-call ratio. And the blue line is the 10-day exponential moving average of the CBOE equity-only put-call ratio. When these lines are falling, that means there's more bullishness, more call buying versus put buying, which is bullish for the market as long as it lasts. However, we're starting to get warning signs here as the level of these put-call ratios has fallen into areas or zones that have preceded both pullbacks and intermediate-term corrections. As you can see, the last two times that the market pulled back, both times were in 2012. The 5-day fell into the 0.5, 0.55 area, and the 10-day fell below that 0.6 level. Each time that occurred, we did get a decent pullback both times, almost exactly at the bottom or the trough of these equity-only put-call ratios. If we go back to the latter part of 2010 and early 2011, we got some very low readings, bullish, lots of calls versus puts, and the level actually fell. It was lower than the levels that we got in 2012 prior to those pullbacks. And we got lower readings, more calls versus puts, and we also got a very extended period where we saw this sentiment indicator in very negative territory or warning territory. It was almost a couple months here that those put calls stayed in that range. What we found from a bigger top perspective is this is just a warning. You never know how far a sentiment indicator is going to go. These could have gone further than where they bottomed out. This one could have gone further. You never know. What you do look for is a change in trend of these put-call ratios. And it's not until you get to that change in trend, which is probably marked best by this line, that you're probably getting closer to some sort of topping formation and then a bigger correction. And you can see that the rise in the put-call ratio started to happen before the market actually peaked out, or while the market was peaking out. And then it took many, many months of this rising put-call ratio and very choppy and toppy action in the S&P before it broke down. So we don't know what's going to happen this time, other than the fact that these are very low, indicating a lot of frothiness in the options market with respect to equity options. And we think this is a warning going forward for the S&P and other major indices as we move into the summer months. This has been Mark Arbiter with S&P's Chart Room.